Strong US retail sales ease recession fears, supporting expectations of a 25 basis point cut by the Fed. Australia's consumer confidence jumps. Singapore's chip exports get a boost. And Bank Indonesia faces a tough rates decision today. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview from the recent ANZ-sponsored AFR Asia Summit, I spoke with ANZ Head of Geopolitical Risk, Cameron Mitchell, who explains why themes of deglobalisation and the decoupling of the US and Chinese economies should be looked at through a different lens.
I'm not all that enamoured by the word deglobalisation. It sounds a little too extreme, but there's definitely a rethinking of globalisation going on among a number of governments.
But first, in 5 and 5 with ANZ, fears of a US recession eased overnight as stronger than expected retail sales numbers, along with solid industrial output and manufacturing, pointed to strong activity in the third quarter. August retail sales in the United States rose 0.1%. There had been expectations for a 0.2% drop, while sales in July were also revised higher. The S&P 500 initially rose, but was down 0.1% at 4 a.m. Sydney-Melbourne time. The yields on US Treasuries rose 2 to 4 basis points, as expectations for a 50 basis point cut by the Federal Reserve tomorrow reduced slightly. Here's ANZ's Head of G3 Economics, Brian Martin.
Control group sales, which are used to calculate GDP, are now running a touch firmer than they were during Q2. So it does suggest that as far as the consumer is concerned, there's still plenty of momentum in the economy. Industrial production and manufacturing output rose strongly. So on balance, the data today indicated that the US economy is not lurching towards recession. If anything, it's still holding up very well.
The US dollar index was up 0.2% with those higher yields. The Aussie dollar was flat at 67.50 US cents, while the Kiwi was down 0.3% at 61.80 US cents as of 4 a.m. Sydney-Melbourne time. Number 2. Now all eyes are on the Federal Open Markets Committee's rates decision early Thursday morning Sydney-Melbourne time and how much support it believes the US labour market requires. But regardless if it's 25 or 50 basis points, Brian says the crucial focus is how much rates look set to fall over the cycle.
We think that 200 basis point rate cuts are there, and if the economy weakens, that more might be needed. And that's really what's important. In the short run, the Fed have to decide what it is that they think is appropriate. We think 25 basis point rates are appropriate. We think there's still a considerable body of opinion at the FOMC that thinks that, but maybe there is something in the data that the FOMC are seeing that we're not seeing that makes them think a bigger move might be appropriate.
Number 3. Singapore's non-oil domestic export growth, 10.7% from a year ago, was below expectations, but there were some welcome signs. ANZ Head of Asia Research, Kun Go, says electronics exports finally fired up. They rose 35.1% from a year ago.
Singapore is a major part of the global semiconductor supply chain, but its exports hasn't really benefited much in the first half of the year because the composition of its products is not as geared up to the AI-related demand. But we're starting to see some catch-up now as we see that broadening of the semiconductor tech cycle spilling over into Singapore. So this could be the early stages of Singapore's electronic exports finally playing catch up to the rest of the region, which bodes well for not only the export performance, but also the manufacturing sector GDP performance for Singapore for the rest of this year.
Number 4. ANZ Roy Morgan Australian consumer confidence rose to its highest level since mid-July last week. ANZ economist Maddie Dunk says the lift was broad-based, although levels still haven't hit the highs they were expected before the Stage 3 tax cuts kicked in mid-year, with consumers holding back on their spending.
There's the potential that many households are holding out for sales events. We know Black Friday's become incredibly important on the retail calendar, and households are incredibly price sensitive at the moment. If you think about the times when we are seeing strong spending, it's around sales events. People are thinking very strategically about how they spend their money and when they spend their money, and they are looking to get a bargain when it is possible.
Number 5. The People's Bank of China has a decision on its one-year lending rate today. ANZ Research is expecting a 10 basis point cut to 2.2%. Meanwhile, Bank Indonesia is reviewing its key policy rate. ANZ economist Crystal Tan is expecting a hold at 6.25%.
BI's previous guidance was for a policy rate cut in Q4, and that was already based on an assumption that the Fed will kick off its easing cycle in September. And secondly, BI is already easing liquidity conditions through reductions in its RBI issuance.
Crystal Tan there. Now, in our bonus deep dive interview, which I did with ANZ's head of geopolitical risk, Cameron Mitchell, at the AFR Asia Summit, I talked with him about the rising themes of deglobalization, friendshoring, and the decoupling of the US and Chinese economies. He says they're not what they seem.
The figures that we've seen don't really stack up to the narrative that we're hearing, and there is obviously a disconnect there. I guess it's a bit like trying to turn around a battleship. You've got a bit of momentum towards globalization, towards obviously the most efficient supply chains you can find, and then even if the mindset among government leaders has changed to one of more resilience, more security-focused supply chains, it takes a significant amount of time to actually bring about those changes. So I think where we're at in the story, if you like, is perhaps sort of 3 or 4 years into what is going to be at least a decades-long reorientation. So the data is not really matching up to the narrative at this stage, but that doesn't necessarily mean that there is not enough intent among a number of countries to actually bring about some of this change. I should finish by saying I don't support the idea or the theory that the US and Chinese economies are decoupling. It's around reorienting those aspects of the economy that both sides consider to be of national security importance.
There has been some movement, though, in terms of foreign direct investment into places like Vietnam, Malaysia, and also Mexico in electronics and manufacturing. Can you give us a sense of how that story is playing out?
We're definitely seeing that, and Rhodium Group is a really good resource for trying to get down to some of the sort of data in terms of which of those trade flows have reoriented. The Vietnam and the Mexico stories are definitely there. I guess the counter-argument, which has certainly come through the data that Rhodium have compiled, is that a lot of those products or a lot of those sort of new supply chains, if you like, are ostensibly reoriented from China. So you're getting goods from China that are being finished in some of those markets and then ending up in the US market or wherever it may be, which of course is in part a product of tariffs. Companies will do what they can to get around those tariffs, and part of it is, I'd say there is an element, to be honest, of those markets being cheaper to produce some of these goods. So it actually helps the Chinese businesses too in many cases where they're looking for more efficient labour markets and so on. So it's a bit of a combination of things, I think.
And this idea of the great trading blocs pulling apart and maybe becoming hermetically sealed over time, it's the way the simple story plays out. But what's your thinking on which types of products and industries are most affected by any of these trends?
Yeah, look, I mean, deglobalisation is the term that we obviously hear a lot. I'm not all that enamoured by the word deglobalisation. It sounds a little too extreme, but there's definitely a rethinking of globalisation going on among a number of governments. And in fact, as a result of the Russia-Ukraine conflict and a couple of other sort of low likelihood, high impact events over the last few years, COVID being a great example, businesses are obviously thinking this way as well. How do we build some more resilience into our supply chains? So I guess there's two stories. You've got a supply chain resilience story, and you've also got a broader strategic competition story between the US and China playing out at the same time. And I guess that muddies the waters. So the second part of your question in terms of which sectors are more exposed or which sectors are more likely to be susceptible to these kinds of government policy shifts, it's clearly those that governments think are of national security importance. So we've seen that in the technology sector over the last few years between the US and China and increasingly US allies. We're starting to see it in the critical minerals sector. And I guess it all goes back to what the US describes as, or at least the Biden administration describes as its small yard, high fence approach. And that is to build a very high fence of defence around a small yard of sectors or critical inputs that it considers of national security importance. I think the problem, though, Bernard, with all of this is that as countries continue to compete at the same time as the new economy or the industries of the new economy start to build out, renewables and so on, what constitutes economic security or national security probably will expand over time. And we've already seen that recently with the US for the first time putting, well, at least this administration for the first time putting tariffs on Chinese EVs. You've seen the yard expand and the fence start to get a little bit higher.
ANZ's head of geopolitical risk, Cameron Mitchell there, speaking to me at the recent ANZ-sponsored AFR Asia Summit in Melbourne. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, September the 18th. Catch you tomorrow with that FOMC decision. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.